Today we're going to start a new 3 video series. This is the first in the series where we talk about client stories. Derek and I, we're out here in the field every day talking to people about their real life long-term care experiences. And so we just wanted to share a couple of those stories to help others kind of plan for their retirement. And so I'm Drew with LTC Tree here with my cousin and business partner, Derek.
Hey, Drew, how's it going? Yeah, today we've been doing this I've been doing it since 1999, Drew for about 20 years. And over the years, we've just come across so many personal stories of real people around the country who have struggled with various aspects of their parents needing long-term care, their spouses need long-term care, and then the planning that all goes into it.
Exactly. So in this series, the first video, we wanted to talk about a really common question and really a question everyone should be asking. And that is, let's say I'm 55 or I'm 60 years old right now. What's the impact of me just waiting 5 years to buy this plan? And we're kind of going to walk through the sort of the mental evaluation that people should do to make that determination.
Yeah. So the honest answer is, if you have good health and you maintain it, it's not going to be a huge difference. Now, you will pay more premiums because every few years, these companies, just like any product, they increase the rates, but it's not going to be a huge deal. So you want to do it when the time's right for you. But the big if is, will your health be the same? And what if it's not?
Exactly. From a financial standpoint, you really aren't going to beat the system necessarily buying it at a younger versus an older age, although it is substantially less expensive at, say, 55 than it is 60, or 60 versus 65. But you have to pay premiums for longer, or if you're buying a hybrid, that money's tied up for longer. But Derek, you really hit the nail on the head. It's the health. And actually, in our third video in the series, we're going to talk a little bit more detailed about that. But let's just talk about the finances, like specifically. What if somebody waits 5 years? How much more does one of these plans cost?
Obviously, premiums are based on your individual age. So it's each year. So 55 is different than 56, different than 57. So it kind of incrementally goes up. It kind of looks like a hockey stick if you look at age 40 up to age 80. Going from 45 to 46, not a huge deal. But as you age, the increase from year to year gets steeper and steeper. And so if you waited 5 years on average, you're probably going to see about a 20% higher rates just from age alone. Now, the other variable that's often you forget about is, in 5 years, are they going to be selling the same product at the same price structure? And from our experience doing this all these years, every few years these companies roll out a new product. It could be called long-term care insurance 2.0, which is the same stuff, just higher rate structure.
Yeah, and it's not like your iPhone where every time the number goes up, the product gets a little bit better. Sometimes they raise their rates. And in fact, in 2026, we're expecting, probably about a 20% increase. And that's assuming you're still 55 years old. So there's kind of a macro trend that we can't escape regardless of our age.
Yeah, so if you couple that with being 5 years older, plus you'll be paying a higher rate structure because it's going to be the same type of insurance, just more expensive, you'll end up paying more in the long run, even though you're paying less years. So the other variable is your health, and that's what we're going to talk about in the next video. But that's also something you might have the same health in 5 years, but what if you don't?
Right. So bottom line is, we're insurance guys. We're not gonna try to encourage someone to buy this if, let's say, they have kids in college and they're paying tuition and all these things. Buy it when it's financially comfortable, but don't run out the clock on your health, because we're all one doctor's visit away from some new medication or some new diagnosis that could make it harder to get.
Yeah, because we talk with people all the time who they start accumulating too many medications, whether they become diabetic, type 2 diabetics, turns into insulin-dependent diabetes, which makes you uninsurable for a lot of these companies.
Yeah, so I'll go ahead and give a preview. In the next segment of this 3-part series, we're going to talk about what you can do if you are declined.
We're LTC Tree. If you'd like to learn more, we help clients from all over the country shop the entire market of companies. We're a broker. We work for you, not the insurance companies. Go to our website, ltctree.com/quote, and fill in your information. We're happy to send you some information from all the companies, or the numbers there. on the website as well. You can call us, and it's often Drew or I will actually pick up.
So we'll wrap it up for now, Derek. Good chatting with you.